Tyre companies have posted a better than expected set of numbers in the first quarter of FY21. In our ideas for profit today, we'll focus on the stocks which could give high returns in the long run. Well, if you see, the natural rubber as well as crude derivatives are the two most important raw materials for tyre companies. Now, looking at the kind of prices they saw, though the natural rubber prices actually moved up from say 125 rupees per kilogram in the range of 130 to 135 rupees per kilogram, prices are still down 10.5% on a year-to-date basis. Now, a sharp decline in the oil prices following the pandemic has also really helped the tyre manufacturers. Now, tyre manufacturers witnessed a fall in the demand from OEMs, and that was because of the ongoing pandemic forced shutdowns. However, after the nationwide lockdown and how that was eased and the unlock phase started, there has been a sharp recovery in the passenger cars or passenger vehicles as well as the two-wheeler segments as well. Now, the farm equipment segment continues to do well as most of the demand comes from the rural areas, which has been least affected by the pandemic. Now, as a result, demand pickup had been quite sharp after the lockdown was eased. Further, timely and higher sowing of Kharif crop is definitely helping demand also over here. Going forward, we do expect that the demand situation for tyre companies will continue to be favorable as the OEMs have also resumed their production at a decent pace, and also there is high pent-up demand that was lacking in the last 2 or 3 months. Additionally, what continues to work in favor of these companies is also the replacement demand. The demand in this segment has really picked up significantly post the easing of the lockdown. In fact, the replacement demand in the month of say June and July, they have witnessed positive growth on a year-on-year basis as well. Now, we do expect this segment to provide some bit of a cushion to weather the demand challenges even going forward. Now, what continues to pose a challenge for the tyre companies is the commercial vehicle segment. Now, even if we are seeing some early signs of recovery in the commercial vehicles industry, the pace is very slow as the economic activities are also just picking up very gradually. Now, as per the government's objective of say encouraging the domestic products, the government has also put an import of tyres in the restricted category. Now, this is expected to increase the volume for tyre companies or the domestic tyre companies in India. Now, also let's look at the earnings of 3 tyre majors, say Apollo Tyres, CEAT and MRF, to really find out if they merit investors' attention at this point in time. Now, Q1 was better than expectations. Amid the COVID-19 led disruptions, Apollo Tyres saw a year-on-year decline of 33.7% in net sales. The decline was higher in India business at 43% as compared to the 28% fall that was actually seen in the European business for the company. Now, cost efficiencies also helped in arresting the EBITDA margin contraction in this case. Now, the company also gained market share in the entire Indian replacement market. Also, the demand pickup from OEMs has also been quite strong in the quarter under review. Now, the management also expects European business to really perform or their performance to reach 90% pre-COVID level in Q2. Now, CEAT also posted a year-on-year decline of 36% in net revenue. That is driven by a 34% volume decline. EBITDA saw a year-on-year decline of 39% as well. Now, the fall in margin was quite marginal and was arrested by significant cost reduction efforts as well. Now, benign raw material prices are definitely they're expected to help in the sustaining of operating profitability during the challenging times that we are facing currently. Now, talking about MRF, the market leader among tyre makers, that has posted a year-on-year decline of 44.9%. That's much more than the peers, and that is primarily due to the supply side disruptions faced during the lockdown. Now, but despite the significant negative operating leverage, it maintained its EBITDA margin at 13.6%, which is commendable in these current times. Now, looking at the valuations, CEAT Tyres stock is trading at a valuation discount when you compare it with MRF and also Apollo Tyres. On a forward earnings basis, the company is trading at 14.4 times FY22 projected earnings. Now, Apollo Tyres is also currently trading at 15.1 times the FY22 projected earnings, which seems quite reasonable at this point in time. Now, bolstered by impeccable track record and its ability to really weather all kinds of headwinds, MRF definitely deserves premium valuation, and that is what it is commanding. It is trading at a valuation of 26.4 times FY22 projected earnings. Now, Apollo and CEAT, are trading at reasonable levels, and keeping that in mind, one could really look at going long in a staggered fashion over here. But despite the premium valuation, MRF could be looked at for accumulation on dips for the long term.